You are listening to Keystone's Stock Talk Show, episode 284.
If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at Keystocks and on Facebook, and keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold.
Great to chat with you again this week. I will kick off the show revisiting the valuation gap between small and large cap stocks, a topic we started focusing on in mid-2023. I'll present a short snippet from a presentation I did this past week at a conference in Vancouver. I will quickly show the significant opportunity in small caps if the valuation gap narrows. In our Your Stock Our Take segment, Aaron answers a viewer question on NowVertical Group, symbol NOW, on the TSX Venture, a data, analytics, and AI solutions company that provides comprehensive software and services to private and public enterprises. A listener asks Aaron if the stock has 10x potential as NowVertical undergoes a transition, selling off less profitable assets, paying down debt, and focusing on profitability. Aaron takes a look at the company's progress and if the stock offers us an opportunity. With Donald Trump being sworn in this week, we have seen an uptick in questions on Bitcoin with a focus on Bitcoin ETFs. Brett tackles a number of Bitcoin-related questions in this segment today, endeavoring to answer all of your Bitcoin-related questions. Finally, Brennan answers a viewer question on MDA Space MDA on the TSX, a provider of advanced technology and services to the rapidly expanding global space industry. The company is profitable and posted impressive growth in 2024. Valuations on the higher end, but if growth can continue, Brennan will let you know if MDA Space offers potential value. All right, let's get to the show. How are you guys? I just literally walked in to the office here after presenting this week, doing some events down there. And I'm ready to go.
And you were presenting yesterday as well, right?
Yes. And I did on the weekend, on Sunday, I did a master course in how to find 10x stocks. So that was an hour and 50-minute video interview with, slides and stuff like that. So it was good. It was good.
So you should be doing my segment today because I'm answering a question from somebody specifically about whether or not a company that they like is a 10x stock.
It's true.
I don't know why I'm doing it. It should be you.
Nobody
doing this segment.
knows. Trust me, nobody knows.
I'll email you my slides.
You should do it.
Yeah.
Now I'll say that what we look for, some of the key points when we look for a 10x stock and where you should be looking. And does this company match up to that? We'll see. Okay.
Yeah, you said also just that the conference was well attended this year. Yeah, it was.
I think the attendance was, it seemed up over last year for sure. In my room, there was standing room only, about 200 people there. It was great to see. A pretty good crowd, pretty engaged. So yeah, there was a lot of activity, and looked like both days there was activity, which is good.
Mm-hmm.
Yeah.
That's good.
All right, let's get to our poll question. This was a resource-related conference. That's not our area, really. There's some companies we have that service that segment, but we thought in honor of that, we'd have a question on gold. Are you bullish, bearish, or what are your thoughts on gold this week? Brett, why don't you take that one away?
Yeah, so the question was, what is your outlook on the price of gold? 65% of our viewers said bullish, 31% said they're neutral, and 4% rounded it off with being bearish. So quite skewed towards being bullish on gold.
Mm-hmm.
Yeah, gold certainly had a tremendous year last year. What was your call,
I don't know.
Brandon?
It had, like Ryan said, it had such a tremendous year last year. I would find it hard to have another year of, tremendous gains. Who knows? I mean, obviously, the past doesn't predict the future. There is that one comment from Tyler, who is a client, and he said bullish, but I'd be pleasantly surprised if it grows by more than 5% at the end of 2025. I think I'd probably agree with Tyler. But I mean, what was it up last year? It was up significantly. So I just don't know if it'll be able to replicate that.
For sure. And it just not, the fact that there's a divergence in thought of where gold will be this year. It's not, I'm not saying it's the most volatile commodity or anything out there, but it has a massive influence on what the stocks that are related to gold are going to do in the sector. That is why it always, when you're investing in gold related companies, a gold producer, explorer, or ancillary company that does services in the sector, you are adding a layer of risk on the top because it's based on that commodity. The company, I always say this, can do everything right. Management can do everything right. If the commodity moves against you in a given year, it's probably, you're fighting hard to have a stock price go up, and it's likely the sentiment is negative and the share price goes down. And, if you're producing gold, the price of gold comes down, you're making less money. So if you have a year again where gold goes up, likely you have significant returns in the segment. Having said this, gold has been going up significantly here. If you look over the past several years, and the junior mining sector has been doing terribly. It's hard to raise capital in there. And even some of the gold stocks, they've had rising gold prices, but inflation kicked in with those companies and they have rising costs, and profitability hasn't yet matched the rise in the price of gold. Now, there are some good quarters that I saw. We looked at every company in Canada over the past few months. There are some better numbers coming out in this sector. So we're certainly looking there. And to tease something for clients coming up, we do have a company that is supporting that sector, ancillary to the sector, that we're likely going to put a recommendation out over the next week. So look for that. Canadian small cap clients, all of our clients, you'll get that in your inbox.
Yeah, well, one thing that I'd also
trades at very low valuations, so that's what we're looking for. Higher risk, certainly, as is any company who is in this sector, like we said.
One thing that I'd like to say as well, just as Brett and I were having the conversation the other day when we were like coming up with this poll question, and just looking at the average price of gold going back, all the way to 1833. Realistically, we only started really seeing gold starting to like free trade. When was it, Brett? Like the late, or the
1968.
1968. Yeah. So, it is interesting that even just like the price action of gold, we really, we've got obviously, 30 or 50 years of it, but, it's interesting when you like look back at an index, I don't know why I never really thought of that before.
It was pegged.
Exactly. It was pegged for a long time.
That's the word you wanted to say. It's true.
Yeah, I wasn't going to say pegged, but
yeah. Well, that's what they called it. Yeah, it's true.
Exactly.
Yeah, for sure. All right. Are we moving on?
Yep.
Let's leave it on a high note.
I know. For God's sakes, let's just get the hell out of there. All right.
Look at me turning red too. That's hilarious. But go on.
No. So okay. So should we get to the next segment?
Yep. We should.
All right. So I'm gonna share my screen here. I'm gonna just start this off before it completely gets off the rails. So earlier this week, I gave a presentation at the Vancouver Resource Investment Conference. I'm going to give you a brief snippet of that presentation today. One of the items that I touched on was the valuation gap between small and large caps. I will go over a snippet of that presentation, like I said, today. This is from section 3, which you really needed to know. I started by I really taking note of this wider valuation gap in favor of small caps around mid-2023 and noted it as a potential opportunity to find high-quality, earnings-driven, smaller companies at a discount. I presented on this in early fall. These were the numbers then at the time in terms of forward PE multiples in the S&P 500 and the S&P 600. We'd already begun taking advantage of this mispricing in the markets with a number of new buys that we came out with in our Canadian small cap research. But let's take a look at the numbers like you see on the screen there, where we were back in fall 2023. This is in early November. There was a very significant valuation gap between large and small cap stocks here. The large caps here are represented by the S&P 500, small to mid caps represented by the S&P 600. So if we can see the S&P 500 traded at around 17.4, The S&P 600, the small caps were about 11.5. That is a 50% premium that the large caps are trading at versus the small caps back at this time. Again, there were some excellent opportunities in this range to find higher quality earnings-based micro cap to mid-cap companies. Now, I often see analysts take a retrospective look back, like we're looking back right now, at the buying opportunities that were there, which is frankly easy. The key is, how did you react at that time? What action did you take? This is key for our investments and our clients going forward. So our first recommendation as the value gap hit its highest level, and their first two recommendations were VitalHub and Cypher. Both have gained just over 300% in a year and a half since that time. But my point today is to really revisit these, the relative valuations, and see if the opportunity remains in place today. So this is kind of a rainbow spaghetti plate looking chart here. It shows the relative forward valuations currently for the US mega caps, large caps, and small to mid cap stocks. I'm just going to break those numbers down more simply here. Small caps again versus large caps. Where are we today? Well, the valuation gap, as we can see there, has narrowed slightly, but the forward PE on the large cap S&P 500 is 21.2. These are more elevated overall than we saw back in November of 2023. But the small cap is about 15.2. It's still large cap versus small caps, a 40% premium. Now, let's put this in perspective. For the better part of the first 20 years of this century, small caps, due to their higher growth and profile, have traded with premium PE multiples relative to their large cap brethren. So this is where we see the opportunity. The continued inversion of this ratio creates that opportunity. If this multiple were to reverse in favor of small caps as it held for the first 20 years plus of this decade, there remains significant upside in small cap companies. So the specific case that we can make here for small caps, the S&P 500's gains over the past 18 months have powered by a handful of mega cap technology stocks, really driven by that. Valuations in this segment of these larger companies are stretched on that end of the market. Well, the small cap performance generally over the past year has underperformed in 2024. I will note that we saw significant outperformance in Keystone's high quality, profitable names. Broadly, this segment has now been quietly gaining momentum. I would say it is in the higher quality earnings-based names where you're seeing that. We have new themes that we're hearing: deglobalization, reshoring, and lighter regulation. Those are all would be considered positives for the small cap segment. Now, the opportunity continues to be centered around the valuation gap between small and large cap stocks, and we saw that average multiples on profitable small caps remain at significant discounts to their large cap peers, and in particular, a premium to the mega caps. In summary here, what we're looking at, the multiples favor the small. The 10 largest constituents of the S&P 500 index trade at approximately 30, or they power approximately 36% of the overall index, and they trade at approximately 32 times earnings on average. The remaining 490 stocks in the S&P 500 are looking at forward PEs in the ratio of around 12, in the range of 21. The S&P 600 small cap index currently is 15.2. We saw that again for the first 20 years of this century. Small caps traded at a premium multiple relative to the large caps. That reversal would be powerful for small caps. We don't even have to see a reversal. Even a narrowing of that valuation gap would be a positive. So with this in mind, we are issuing new small cap buys this week to clients. So look forward to that.
I had brought this up as well just during our prediction show. So like looking at like the small cap versus the large cap returns in 2024, because I basically said that small caps would outperform in 2024, but I was wrong. And again, the S&P 600 returned about 12% in 2024, while the S&P 500, I believe it was about a 26% annual return. But again, more than half of that, the S&P 500's 26% annual return was driven by the Magnificent Seven, higher. So again, just something to keep in mind.
Yeah.
Yeah, it's
It is
crazy the way
amazing to
that
see.
those companies really dominate, and especially like when we're looking at, the average large cap valuation. I mean, you're basically looking at the valuation for those 7 companies, which is going to skew to be higher likely than a lot of the other large cap companies in the US. A counterpoint to that, though, of course, if you look at the technology sector, a lot of the leaders like the Microsofts and the Googles, while not cheap, actually still trade at what we would consider to be reasonable valuations in the 20 times range, or in Microsoft's case in the low 30s. But if you go into the mid cap or the smaller large cap, the true large cap software technology space, for companies with similar fundamentals, you'll actually see much higher valuations. And that really probably just comes down to a perception, maybe not correct, but a perception that those companies will be able to generate significantly higher growth long term, because they're not as large and they're starting from a smaller base. Whether it actually happens is another matter.
Good. Okay. Well, let's get to Aaron's segment. Aaron, you're going to start with your stock our take. We got a question from a viewer looking at a company that they believe could be a 10x stock, or they're just asking us whether or not this company could be a 10x stock, and that is NowVertical.
Great, thanks, Ryan. So we're going to take a look at a viewer email that we received. It's a pretty direct question here. It's about NowVertical Group, NOW, on the TSX Venture Exchange. He says it has 10 times potential. Have a look at it. So straight to the point, he wants to know if this company that he likes would be classified as one of our 10-time potential companies. And I think this comes from one of the recent DIY seminars that we did that focused on 10 times small cap stocks. So Ryan's talked a lot about that. I said at the start of the podcast today, I don't know why I'm doing this segment. Ryan is the one who is the 10 times guy, or maybe Brennan is the true power behind the scenes, but not me. But anyways, I'll do my best, and these guys can chirp in when I'm finished here. So NowVertical, what this is a technology company. It's data analytics and AI solutions. So they provide these services to private and public enterprises. I operate in the big data industry. And essentially what they do is they're providing software solutions as well as professional services to companies that have data and want to find a way to monetize that data, to turn that data into actionable intelligence, so that they can essentially become more competitive and serve their customers better, and ideally expand their market share. This is a micro cap, perhaps even a smaller than micro cap company, Pico Cap, a 43 million market cap right now, 50-cent stock, and 87 million shares outstanding on the company. So if we look at how the company's done, NowVertical has performed over the last year, you could see it was pretty dismal up until about November, when the stock started to take off. And since then, going from a bottom of 8 cents to now up to almost 50 cents. So what happened at the time? Well, first of all, there was the release of the Q3 2024 financial results, and we'll take a look at those in a couple of seconds. Those were strong, and there were some things that the company was doing that the market liked. And then later on in November 26th, I believe, was the announcement of a partnership with Microsoft as well. So stock has been performing extremely well. Let's take a look at those financial results. So if we look at the financial results at face value, revenue is actually down 29%. But what's happening here is the company is refocusing its business. So it's divesting or selling some of its assets, presumably assets that are not as profitable, or assets that they don't see as being core to their business or having that long-term growth profile. So revenue was down, but if you were to exclude the divestitures and just look at the organic business, the assets that they're keeping going forward, those revenues grew by 9%. A gross profit margin was fairly stable, down just slightly. Adjusted EBITDA again was down, and this was large. This was due to the divestitures. But net income was up, so up 144%, but really minimal net income here. I mean, 600,000 for the quarter, up from 200,000, but still seeing that go in the right direction is a positive signal. So basically what they're doing is they're addressing what they believe to be a critical need in the market. And that's that there are enterprises, companies out there, they need to find ways to be more competitive, to be more efficient. AI provides that solution, but most of these companies don't have the expertise to implement it. So NowVertical is the type of company, they're coming in with the software solutions, the expertise to essentially help these companies utilize their data in the best way possible. There's certainly a big market for this. It's an understandable business. There is market demand. I think there's also a lot of competition, but the top providers are going to rise to the top. There will be competition. Most of it will probably not be top tier. So for those companies that can provide a great service and great expertise and solutions, I think that there is an opportunity here. Now, part of what the company has been doing is they've been refocusing their business. They call it the one brand, one business strategy. What that is including is divesting a lot of their assets that they don't want to keep long term, and then really focusing on one unified business that is transitioning to profitability, or that will be profitable long term. So we love that focus on profitability. Too many companies in the micro cap and small cap space, particularly in the technology space, they don't prioritize profitability. But we've seen it many, many times before. If companies continue to burn cash, they have to go back to investors, raise more money, take on debt. It generally doesn't work out well for most long term. So we do like that focus on profitability. Now, looking at the historic performance here, there's really only a couple of years of record of the company as a public entity. So we only have 2022, 2023 really. And we did see from year to year, very strong revenue growth. Now for the 9 months again, revenue was down for the year to date period in 2024 compared to last year due to those asset sales primarily. Now there is a bit of an issue here, and that issue is with the company in this transition, in the process of selling assets. It's really hard to get a feel of what the business is in terms of, you know, how much of the revenue growth was coming from the assets that are going to keep going forward, how much is attributable to the assets that are being sold. So it really kind of muddies the water. It creates a lot of smoke here. It makes it a little difficult to analyze. And when we have that situation, we really need to take our time to understand exactly what is being sold and what is being kept, and how that factors into the historical and future performance. But just on the note of profitability here, again, this is not a company that has what I would say fully transitioned to profitability. They're in the transition. Historically, in the couple of years that we have, they were losing money. For the first 9 months of 2023, they lost 3 cents. And then for the first 9 months of this year, they gained a penny. Again, we don't know exactly what assets are contributing or taking from that. So it'll be good to have, it'll be better to have a cleaner picture of the company once they're finished with this transition of selling some of their assets and the reporting results with the new business. Looking at the balance sheet, there is some debt, about just under 15 million in debt, 3.3 million in cash. Now, there is not really enough EBITDA to make a calculation here. I'm kind of looking forward here. The company did indicate in their presentation that they, 8 million in EBITDA, adjusted EBITDA, 2 million in the last quarter. So you just multiply that by the 4 quarters. That's a pretty quick assessment. I mean, I would not depend on that as being something that we can look at going forward. But just to get some context here, if we were to use that, that would be net debt to EBITDA of 1.43 times. Not a bad leverage ratio. But again, we're talking about a small microcap, picocap company that is not yet fully transitioned into profitability. So ideally, we would like to see no debt to this business. But that may be what the company is looking at long-term as well. And then just in terms of valuation, I'll just go off again that 8 million in annualized adjusted EBITDA. And then if we were to calculate the enterprise value, that would be an EV to EBITDA multiple of 7 times. Given again, the fact that, there's not really clear profitability here yet. It's unknown what the future revenue growth is going to be, or it's difficult to target it at this point in time. 7 times is not what I would consider to be an extremely attractive valuation. for a company of this size and in its position. It's not bad. I would probably consider it to be more fair value. Now, our takeaway, we do think it's an interesting business. I do think it is. It's understandable. There is a market there that they have the opportunity to capitalize on, and we like the idea of the strategy to transition the business and focus on profitability. Strong revenue growth historically, and there's the signs that they may be transitioning into net profit. But on the negative, it's complicated to analyze with everything that's going on with the company right now. There's only a few years of history we have with them as a public company. There's no operating cash flow at the moment, even though there's some positive earnings. The balance sheet and the valuation, they're okay. They're not what we would consider to be especially strong. So our take, we think that it is worth following this company over the next couple of quarters, and it does have great potential. I'm not going to come out right now and say that this is going to be the next 10 times stock. They have a lot to prove. What we're going to be looking for is for them to, create or provide a cleaner picture of the company going forward and more consistent net profit, and then growth in margin as well, along with revenue growth over the next 2 to 3 quarters.
Yep. I don't think you understand the technology. Just kidding. No,
No,
that's a good
I'm
summary.
sure. I mean, part of the reason why I really wanted to do this company as well is because I knew that, I would get trashed in the comments, and I love the attention, I guess. So,
Positive
no,
or negative. Yeah.
I think that, they're doing some interesting things. And I like the market, but it just, for our criteria in terms of the profitability based criteria, it doesn't hit that yet. And I'm not confident enough that we're going to see a big explosion in earnings over the next 1 to 2 years. It may happen, but it's a show me situation.
Yeah, it certainly, as of yet, doesn't have the track record in terms of earnings that we're typically looking for when we're looking at the next 10x stock. And when I presented on this, you need, it is a small company, so it checks off that criteria. It's about 87% of all companies that went up 10x in the last 10 years, essentially, started small. It's 80 something percent of those 82, I believe, were profitable before, and 91% had profitability prior to that. So, but this company is kind of just on the edge of that profitability. One of the things I would note is typically we're looking for a stronger balance sheet to start. You can't always have that, but a little bit stronger balance sheet would be good. And I do note on this company, if we look back to 2020, I think they had 14.9 million shares out, 2021, 40.1, 2022, 63.4, 2023, 75.6, and then trailing 12 months or trailing 12 months is about 80.6 right now. So, increasing that share count significantly over time. So what drives the stock price over the long term is per share cash flow and per share earnings growth. So they're fighting against a higher and higher share count. It's harder to grow per share earnings. And Aaron talked about a lack of operational or cash flow just in general at present. We'd like to see positive cash flow. So those are some other boxes we'd like to check off. It's moving in the right direction. Obviously, we'd like to see a focus on profitability. For the valuation, that's a forward multiple you're doing, EV to EBITDA there, right, Aaron? With a 9% potential organic growth rate, it might be, just fairly valued right now. If they can continue to grow at that rate. If they don't, it's not. I did note too, when I looked at the company, they had a spike up in adjusted EBITDA. Now they've sold off businesses, so it's not like to like, but they had a spike up from Q1 to Q2 to Q3 in 2023. It went from 3% adjusted EBITDA margin to 11 to 18. And then it dipped down in this transitionary period, this strategic shift period, down to 8% in Q4 of 2025, then 11 in Q1 2024, 14 in Q2 of this past year, and the last quarter, 19%. So going in the right direction again. But, is there a step back? Maybe they keep moving forward or maintain these margins, but you have seen a spike up before, which you could have made a good case this business is heading in the right direction. And then, boom, they made a strategic shift and you saw a drop down in that EBITDA. So volatility there, looks like on the right track. Perhaps we'll interview management, but there's some things that don't meet our criteria at this stage because we have a very stringent criteria. So hopefully that makes sense. let's move on. Unless you guys had anything else on now. No, nothing for now.
We can move on now.
All right, now we will. Okay, we're just hilarious. So I think we're going to look at Brett, right? You're going to talk about Bitcoin ETFs, and the risk therein, potentially.
Yeah, exactly. So this is really more just a combination. We've had some general questions just on Bitcoin ETFs, and cryptocurrency in general. I'm going to focus more on Bitcoin, but we've seen now with Trump being elected and he launched his own meme coin, and as well as Melania's meme coin. Those I would just stay away from. I'll just say that I'm not going to really do any analysis on it past that. But really, there's just been an uptick in overall interest in Bitcoin as well. Trump's floated a Bitcoin reserve in some sort. Whether that comes to fruition, I have no idea. But that's really where the interest is coming from. We've had questions related to Bitcoin ETFs, how you should sell. Should you sell it? Should you hold it? Blah, 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 blah. We'll just look at a high level view, look through it, and hopefully I can answer some of those questions here. And I will preface this with Bitcoin, or any cryptocurrency for that matter, has never been a Keystone recommendation. We focus on stocks. Cryptocurrency isn't our bread and butter by any means. So moving on, likely part of the interest is just really due to Bitcoin's recent performance has been strong, setting a new all-time high over this past weekend at roughly 109,000. And over the past year, the total return is about 165%, stoking more of this investment interest with continued high returns. And it's currently trading at about $105,000 a coin. But by the time you're listening to this, that is probably way off because it is cryptocurrency. So a quick overview of really Bitcoin ETFs, the pros and cons. If you are looking to invest in Bitcoin, the biggest benefit of using an ETF is really just the ease of use. With self-custody or holding Bitcoin through a cryptocurrency exchange, it comes with various risks, and it's just generally more complicated for most people. So if you just don't want to deal with that, as you can make mistakes in transferring or purchasing, losing your keys, which is effectively the same as losing your wallet of cash, amongst other hurdles, if you wish to go that route. But a lot of people just don't want to do that. So ease of use when it comes to ETFs. These are not really impossible hurdles across, but just this really more peace of mind by letting our third party handle or hold your investment if your point of holding Bitcoin is to hold it as an investment. A couple of the drawbacks, however, of ETFs is you are getting someone else to hold your investment. They're going to want something in exchange. You're going to pay a fee or a MER, managed expense ratio. And you can only trade during normal stock market hours, unlike where if you have self-custody or through a cryptocurrency exchange, it'll be 24/7. And like I was saying before, Bitcoin's at an all-time high over the weekend. An ETF wouldn't be able to sell during that time. You are restricted to normal stock market trading hours, depending on, of course, which exchange you are buying it on, whether it's in Canada or the US or abroad. But if you are looking at Bitcoin purely as an investment asset, not to use it like a currency, then ETFs are likely suitable for you just because they're so much easier and the fees aren't significant compared to the assets, just general volatility. So just over a year ago now, in the US spot, Bitcoin ETFs were listed. They had some futures, which are derivative-based ones prior to that, but they've only had spot Bitcoin ETFs since last year. And prior to that, Bitcoin ETFs were actually listed in Canada prior to the US. But recently, BlackRock launched a Canadian Bitcoin ETF symbol IBIT that is linked to their American one. And it looks to be the lowest fee in Canada at this time at 0.32%, tied with Fidelity Bitcoin ETF at BTC, as they quickly followed BlackRock's lead, lowering its fee to the 0.32% as well. The other benefit, though, which I really want to highlight and reason why I'm really bringing this up is since it is linked to their American-based ETF, it will generally result in a lower bid-ask spread, which was a bit of a concern when you were looking at the Canadian ones a year ago, as well as they just weren't as liquid in general. So if you had a larger position, you want to buy it all at once and through a market order, it might have moved it a bit more. You might have had a bit more slippage. So, and it's just generally good to see a bit more competition in the Canadian ETF spaces. Overall, they were just worse than the American offerings. So if you're comparing the Canadian to the US Bitcoin offerings this time last year, even though the US ones just came onto the market, they were lower fees, lower bid-ask spreads, higher liquidity than effectively all the Canadian ones by quite a bit. But overall, if you are looking between ETF, one Bitcoin ETF compared to another, there's not really much of a difference. The only real difference is that MER. Past that, you have your bid-ask spread, which are all effectively a penny at this point, or maybe 2 pennies at the time. So really nothing there. And then the other difference, which you can consider maybe, is the custody. So BlackRock doesn't actually go custody of the Bitcoin, but for the most part, it's just all through Coinbase. Fidelity does do their own custody, but for the most part, it is just purely Coinbase custody. So even there, not much difference. So look at the feed, but don't stress too much about it, as it's very minor difference. A lot of them are within a fraction of percent, and you're looking at upwards of like 10 basis points for the US difference at this point, if you're excluding grayscale, which I'm not going to get into now, but they're higher for a reason, just because of historic reasons. But it's not that big of a deal. So if you do see one provider lower their fees by 0.01%, don't freak out. You don't need to switch. Likely, if you're trading through a bank, your trading fees are going to be higher than what you'd actually save from the MER differences. However, changing pace for the next couple of slides, really, why would you want to hold Bitcoin in the first place in a multi-asset portfolio? Traditionally, you've probably heard of the 60-40 portfolio, 60% equity, 40% bonds, as different asset classes have lower correlations with one another. So that can result you in having a higher risk-adjusted return. Aaron actually did a segment on it with international markets not long ago. So really, a lot of people and institutional investors are really looking at, can Bitcoin be used as a diversification asset to increase your risk-adjusted return? And I will say, and this is all based on correlation. So Bitcoin can be used in a similar sense. If you don't have perfect correlation, it will have some diversification benefits. And the lower correlation, which is 0, is the lowest possible. It means it's completely uncorrelated, would be the best for this practice, but that doesn't really happen in the actual financial markets. And as you can see here on this chart, correlation between assets does shift over time. It's a statistical relationship based on price. So it will shift over time. And this is a 30-day rolling correlation, which I have up here over the past 5 years. And as you can see here, it's not consistent on a 30-day basis, with correlation dropping slightly negative at points, meaning it's slightly inverse correlated. And it has actually a high correlation of 0.8 at its peak on this graph. So it does shift over time. It's not going to always stay that same. So if you are looking at some quantitative arbitrage, which is well past the point of this presentation, that is something to consider, but that is well even past what I would do. But for the most part, I will say on the long term, if you do a longer term correlation past 30 days, this is rolling correlation, you can do that for really any period of time. It kind of hovers around 0.4 for the last few years. So it's not an exceedingly strong correlation, but it is still a positive correlation nonetheless. But you can ultimately use it for increased diversification. I'm not really going to go into how to implement a modern portfolio theory, as it does get complicated and it's really out of the scope of this segment. As well, it depends on your other holdings and a myriad of other factors in reality. But the point here is just to show that there is some diversification benefit based on historic price movements, which I will also say the standard caveat past performance isn't indicative of future performance, but it does at least historically have some sort of a diversification benefit, since it has a relatively low correlation with S&P 500 as well as other assets. Now, looking at Bitcoin volatility, it is a volatile asset to say the least. However, volatility has been slowly trending down over the long term, which isn't surprising, as higher value assets tend to have lower volatility. The more people you have in the market, the less volatile it is in general. But Bitcoin is still very high volatility. So if you analyze the volatility over the past 30 days, is about 43%. And just for a point of reference, the S&P 500 over the last 30 days was about 15%. So even though Bitcoin volatility has trended down, it is still a highly volatile asset. It's much more risky than a stock market index. And even if you compared it to individual stocks, it is more volatile than most, especially during market stress periods. So you can see on the left side of this graph, that big spike up, that was the onset of the COVID pandemic. And when you analyze that volatility, even though it doesn't show it here, I think for a very brief period of time, it was actually over 200%, depending on your correlation or your volatility period. So extremely high volatility at certain times, especially when there's market stressors. So next, we can look at actually the drawdowns, which is a bit simpler since it's not a complicated stat. And it's really just how much the price fell from its prior all-time high. In this chart, you can see Bitcoin has repeatedly fallen significantly, with the most recent major drawdown being roughly 75% from its peak. And if you go all the way back to 2012, even though it was a very structurally different market, Bitcoin actually fell over 90%. So if you do hold Bitcoin, whether through an ETF or otherwise, you really need to accept the high likely possibility that you could lose the majority of your capital, at least for a period of time, if the historic pattern holds true, which of course it may not. But it really does show that if you are willing to hold Bitcoin or any really high volatility asset, expect your dollar value to drop significantly, even over a couple years, like you can see here. Even a few years ago, you were looking at a 75% drawdown. That would have been when FTX collapsed. And really just a couple points to tie this all together, as it is a bit of a generalized segment. If you do look to invest in Bitcoin, look at the risk of holding it. ETFs are a suitable way to hold Bitcoin as an investment. And what I would say is the easiest risk management approach is really position sizing. Don't bite off more than you can chew. Assume Bitcoin can and will drop by at least 70% or more, or even more. Just assume it can effectively drop to zero. Assume worst case scenario that valuation can go to zero like everything. But given the overall volatility, that's likely has more of a chance to go to nearly effectively zero. It's unlikely to go to zero, but 0.001% is zero in my books. Also, the larger position you have, it has a fewer diversification benefits. That's true for any asset, as when you have a larger position relative to your portfolio, it will have a higher correlation with your portfolio, reducing the diversification benefits. So set a rough position size maximum. If it exceeds it, then lower your position to lower the concentration risk, which lowers your portfolio's overall volatility. Obviously, what people are comfortable with will vary, but a general initial position will likely be in the low single-digit percentage, 1 to 3%. Since it does have such high volatility, you'll see that number, it will maybe 1, 2, or 3% on where you read online. But the reason why this is because once you get above that, you'll start to have a significant portion of your portfolio's risk concentrated just on Bitcoin. So if you got like 10, 20%, much of your portfolio's movement will just be purely based on Bitcoin, which, as I showed, is very erratic, even over short periods of time. But ultimately, invest in what you're comfortable in with. If you do believe in Bitcoin, is that it is going to fall to zero and has no value in it intrinsically, and it's just going to trend to zero as a scam, or however you do believe that, simply just don't allocate towards it. But if you are someone who is overly bullish on Bitcoin, really measure your risk. Make sure you can actually afford to take that risk. No asset is guaranteed to have high returns just because they did in the past. And as well, don't have a fear of missing out when you do see these high returns, as that can just purely lead to poor investment decisions. So I'll open it up to you guys here if you had any comments.
Yeah, it's interesting seeing the correlation for sure. I like that you did that, and I know that I gave you kudos when we published the report, the Bitcoin report, to clients. Again, not making a recommendation, but just giving them some good information essentially,
Yeah,
if they are interested.
Yeah, I
It
think that
was,
we've always said, we've never said don't have Bitcoin, but don't make it,
Mhm.
a massive part of your portfolio, just like with gold or anything else. It can you can have an allocation. Not everybody necessarily needs to, but we would say 5%, not 50.
Mhm.
Yeah, and certainly there's a lot of headline news. I mean, the
Yeah.
Melania, the
Yeah.
Trump, Bitcoin that came out. Yeah, I mean, if you want to buy cryptocurrency, stick with the big names. If you're going to do that, as it is, there are a lot of scams out there right now, and people are losing significantly. They're seeing big profits, but I don't think you're seeing the losses on the flip side in some of these companies. So I'd beware, or not companies, in some of these coins.
Yeah,
hmm
it's exactly like what Ryan was saying is Bitcoin is kind of on its own. Then you have like Ethereum and a couple other kind of middle tier ones, but then a lot of them are just, if not outright scams, they're just bad investments.
Or just
As simple as
worthless,
that. Yeah,
basically. Yeah,
exactly. Like
there's no
it's
way to assign value
nothing
to
more
them.
to them than that.
Yeah, I
Yeah.
think I've said maybe this story on the podcast before, but one of my buddies was at a party, and he was talking about, Bitcoin, and just asking him like, oh, do you own any Bitcoin? And they're like, you don't want to own Bitcoin. You want to own, this shit coin, basically is what they're called. And the reason being is because it was trading at 0.000001 of a penny. And it's, the thought process behind this
How could it not
individual
go higher?
is,
Well,
well,
it's
exactly.
There
guaranteed.
you go.
If it goes to a penny, then I'm going to be an absolute millionaire, and it should be easy
Mhm.
for it to go to a penny. Again,
Which
it's
is the
just,
It's
same
just a
same
penny.
thing that most penny stock investors think, right? I
Yeah.
mean, they'll
Yeah.
look at a company that's trading at $50 and say, well, that's expensive,
Mhm.
not really taking into account that it's maybe trading at a very attractive valuation relative to its cash flow, but they'll gravitate towards a company that's trading for pennies because there's the speculative upside of overnight doubling your money, right?
yeah.
We know a lot of companies that are trading at $100 plus that are cheap, and a lot of companies that are trading at 10 cents or other that are under or that are expensive.
Yeah.
So
There was that one
it's
story too about Boyd with, I know that Ryan told me the story where there was an individual who basically was saying, I don't want to invest in Boyd because it's trading at $100 per share. How am I supposed to make a nice return off that? And it ended up doubling that year, I
yeah,
believe to $200. So
yeah,
again, you got to look at value, not price. We say it all the time.
yeah. Well, Microsoft has gone from 98 to
Mhm.
where is it today? 400, and yeah. I mean, yeah. It really doesn't. It's value, not
Mhm.
price, that we're looking at. I mean, and
Yeah.
again, there's a lot of really expensive stocks trading at 5 cents on the TSX Venture, and you shouldn't be touching those with a 10-foot
Ironically,
pole.
they're the most expensive.
Yeah.
Yes, it's crazy. Okay, well, we're going to go to another kind of intriguing company, MDA Space MDA on the TSX. Brennan, that is your your individual question to tackle this week.
So yes, this was a question that came in from a new client, Brian, and he says, "Can we have another review of MDA Space? The company has seen a lot of growth since August of 2023, from $8 per share to $30 per share." I think he's just meaning the share price essentially. Perhaps it's at full or overvalued, but would be interested in your take. So MDA Space Ltd, or MDA on the TSX, currently trades at a price of about $27.41 and has about a $3.4 billion market cap. Now, they are a leading provider of advanced technology and services to the global space industry. And the company primarily serves the US and Canadian governments. And the company has three segments. Number one is geointelligence. Number two is robotics and space operations. And number three is satellite systems. And if we look at the most recent quarter, about 60% of revenue came from satellite systems, 24% was robotics and space operations. Or sorry, 24% was robotics and space operations, and 16% was for geo intelligence. Now, we have covered the stock on the podcast before, and the last time was in April of 2023. Since then, the stock has had a strong run, up about 300%. So let's take a deeper dive on the business to see what's driving the stock and see whether it is fully valued or not. Now, looking at the recent quarter of Q3 2024 ended September 30th of 2024, revenue increased about 38% to 282.4 million. This was driven primarily by higher work volumes across the business, with strong contributions from the satellite systems and robotics and space operations business lines. Gross profit margin was about 27% compared to 28% for the same period last year. Adjusted EBITDA was 55.5 million, up about 30% from the same period last year. And Q3 adjusted EBITDA margin was about 20%, which is in line with the company's full year adjusted EBITDA margin guidance of about 19 to 20%. Now, net income was 29.5 million, up 217%, driven by higher operating income and higher other income. But if we look at adjusted net income, it was 34.7 million, or about 28 cents per share in Q3 2024, which was an increase of approximately 60% year over year. Now, operating cash flow was about 258.8 million, up from a loss last year, and backlog was 4.6 billion at quarter end, which was down slightly sequentially from Q2 of 2024, but up about 49% compared to Q3 of 2023. And management noted that this elevated guidance provides good revenue visibility for 2025 and beyond. And this year over year increase in backlog was driven by new order bookings, including the $1 billion award for phases C, D of the Canada Arm program announced in Q2 of 2024. So generally, I just want to kind of pause here and say fundamentally, the business has been performing quite strong in 2024 with good growth in backlog, which has been translating into both top line and bottom line growth in the mid double digit range. And one thing that I would like to point out here, though, is that due to the nature of their contract driven business, results can naturally be lumpy. But the recent trend in financials over 2024 are certainly leading to the increase in the share price. Now, quickly looking at the balance sheet, it is in a net debt position of 259.1 million, which provides a trailing net debt to EBITDA multiple of about 1.4 times, which is reasonable in my opinion. This compares to when Brett covered them last. They had a net debt to EBITDA multiple of about 1.3 times. And like Brett pointed out in April of 2023 when he covered them, the company has hedged about 225 million of its credit facility with interest rate swaps. So it is not overly sensitive to interest rate changes. Now, looking at valuations and forward guidance, the company recently increased their guidance when they reported Q3 2024 results, now looking for growth in revenue of about 31% over 2023 and adjusted EBITDA to grow about 19%. And management also noted, we continue to expect favorable working capital conditions related to the Telesat Lightspeed program to result in positive free cash flow in 2024, allowing us to continue to deleverage our balance sheet. And now looking at the valuations. So MDA is trading at about 48 times trailing accounting earnings, 32 times adjusted earnings, 17 and a half times forward adjusted EBITDA guidance, about 19 times trailing adjusted EBITDA, and a price to cash flow from operations of about 8.6 times. So generally, given the recent growth in earnings, I do not think that the current valuations are insane. But the stock is certainly trading at a bit of a premium, in my opinion. And this is partly because it's somewhat of a sexier space. There's been a lot of headline news just in the space sector, I guess, lately, especially with Elon and SpaceX and whatnot. But it is essentially a lower margin manufacturing company, which we have to keep in mind. So just quickly looking at a couple of operational updates. In Q3 of 2023, the company broke ground on their satellite systems facility expansion in Quebec, which will add about 185,000 square feet of advanced manufacturing capacity. The facility is expected to double satellite manufacturing capacity and is expected to be operational in the second half of 2024. And Telesat, which is another public company, partnered with MDA back in 2023 to be the primary satellite contractor for the Telesat Lightspeed constellation. And in December, they announced they had completed the spacecraft's preliminary design review and plan to transition to the program's engineering and manufacturing phase shortly. So to conclude here on MDA Space Ltd. So growth in backlog, top line revenue, and earnings have propelled the stock higher in 2024. The balance sheet remains relatively healthy with a net debt to EBITDA multiple of about 1.3 times. The valuations of 17 and a half times forward 2024 adjusted EBITDA and about 32 times trailing adjusted EPS are premium multiples. But given the recent strong growth, I do not believe they are unreasonable. And the additional satellite manufacturing capacity coming online in the second half of 2025 is intriguing for future growth. That is, if management can continue to fulfill the additional capacity. And there could also be some additional costs that come up as they commission the facility, which is, just generally another thing to look out for over the next few quarters. But the bottom line is, I do believe the stock is closer to fair value in the near term, and one must pay a bit of a premium to own the stock. But long term, I think that it's a decent business. Keep in mind, revenues can be very lumpy quarter to quarter, and one should continue to track order backlog and bookings to get a sense of the business's direction. We did see backlog sequentially come down a little bit in Q3 from Q2, but it is up significantly year over year. And now here, I would like to just open it up to the guys and just kind of talk about the valuation a little bit. Do you guys agree, with what I'm saying? Do you think that it's, massively overvalued at this point? Again, it is a manufacturing company. you guys let me know.
No, I think you did a good summary in tracking the backlog. The little dip there, I mean, it's still up
Mhm.
great year over year, but
Yeah.
the dip is something to follow. If they end next year with a higher backlog and they deliver on their growth, then it's fairly valued to maybe slightly undervalued. But there is, in a contract-driven business, you got to keep piling those contracts onto the backlog.
Yeah.
If the reverse happens this year and the backlog moves lower, and even if they do have higher earnings, that's a concern because they have to backfill that backlog at some point to be able to be at the same level they are today. It does look like the demand is, solid. So it's good to see, but it's certainly not like expressively cheap. I wouldn't say, my God, this stock, I'm pounding the table to look at this, but if they can grow at the rate they're expected to grow at and continue to do that going forward, it is a company that we could look at. But it all depends on the growth. This isn't a SaaS business where you're like, customers are extremely sticky or anything, and their sales are extremely sticky. So you got to keep mounting that backlog. And when even a smaller company that we look at, we got to monitor that backlog closely. And if it, sees a meaningful dip and then there's a not so positive outlook for management, that's where you move out of a company like that.
Yeah, exactly. And like, just on like this note as well, like I believe when Brett was looking at it, we were actually seeing adjusted EBITDA decline, I believe. So, that is just like something is, we all of a sudden we've seen this good growth period in 2024, but
Mm-hmm.
we're coming off of maybe periods that weren't as strong.
Yeah, at that time, I think they were guiding towards effectively no growth for 2023 compared to 2022, which is why they had a lower valuation. They weren't expecting to have that growth. And then you did have these big contracts come online. They've expanded their really everything at this point, improved across the board. So that's a good thing to see. And it's just whether or not they can continue to do that or not.
Exactly.
Because if they fall back to where they were, you likely see the valuation contract. I think the valuation multiples effectively doubled since when I looked, or even a bit more.
Yeah, I think even a little bit more. And that's
they've
exactly
definitely performed.
So all of a sudden, like, if all of a sudden we saw that backlog pull off, growth all of a sudden starts to taper, you could see the company, trading back at, 10 times EV to EBITDA easily, in my opinion. I mean, if growth hopefully continues, for investors, that would be awesome. It maybe would continue to trade it where it's trading.
All right. Well, that's going to end our show for this week. I have to get to a client call, so I got to cut it off there. If you are watching this on YouTube, make sure to smash that subscribe button. If you are viewing this wherever you consume your podcast, rate and review us. And as always, I'd like to wish you profitable investing. Thank you.
Thank you.
Thanks, everyone.
Thank you.